लो ये कुछ हाँ बढ़िया बढ़िया। तो आ जाना यार, आप ही आ जाना। तो यहाँ वो तो हाँ हाँ, नहीं आप तो रिगार्ड से बोलते हैं कि एक अच्छा प्रोग्राम। नहीं नहीं, हाँ आप हमारे एक अच्छे टीम मेंबर हो, इसलिए बोलते हैं आप काम कर रहे हैं। ठीक है, ये मतलब करिए। ओके। पीछे पे रखो, तो पीछे रखो, पीछे इसको निकालना। वो होगा शायद, शायद वो होगा शायद। माइक लाइट नहीं आ रही इसकी। इसमें पावर नहीं इधर वाले आ गए यार। अरे वो तो मैंने उस पर किया है इसलिए आई है। चलो लगाओ वो लाइट नहीं, इसमें पावर नहीं है ना। तो मैं नहीं करूंगा, इधर वाले भी नहीं है, बहुत दूर है। अरे आ जाएगा, बड़ा है सामने ले आओ। फिर बोलो। ये बात कुछ नहीं है, मैं उनको फोन कर रहा हूँ। तो छोड़ो यार, जो नहीं है काम थोड़ी रुकता है, वो तो हमने किसी के रिगार्ड्स के लिए बोलती है, समझो। अपने को अभी 5-10 मिनट का प्रोग्राम है, उसके बाद करते रहेंगे वो लोग अपने। आप लोग सब चले जाना अपने अपने काम से। और क्या कल कोई तो ये ना बोले कि सर ने हमको नहीं बुलाया, तो अपने साथ साथ में रहते हैं, मैं हर को थोड़ी बुलाऊंगा, मतलब है ना, तो सामने पढ़ते हैं जो, समझो। आप एक तो काम कोई बड़ा काम पड़ेगा, ऐसा कोई बड़ा काम नहीं है, हो जाएगा। कुर्सियाँ, अरे ये तो मतलब कोशिश करेंगे ना हम, ऐसी हमेशा करने की ना। तो वो नहीं फिर ना। मेरे को लगता हो सकता है खुद ही छुड़वाना चाहता भी हो। हाँ, तो हम बोलने तो
बॉडी बिल्डिंग No, it's
म्यूट ही होता है वो तो।
आपकी क्लास म्यूट है।
अब पता क्या,
अब
म्यूट म्यूट तो ही है।
അഭിപ്രായപ്പെടുന്നു. പരീക്ഷ എഴുതാൻ
Hello.
Good morning, everyone. Good morning, Santoshi.
Yeah, good morning. How are you, sir?
Very fine, sir. How are you, sir?
Good. Doing well.
Good. Shall we start, sir?
Yeah, we can start.
Yes. Sir. Kajal, madam.
Yes, sir.
Kajal, yes,
Hello.
please start, sir.
Good morning to everybody.
Good morning. Good morning.
सर ये एक रिक्वेस्ट है, देखिए हमारा जो रहा देश क्षेत्रवा जो है म्यूट हो गए।
रतनदेव सर, आपका जो माइक है वो म्यूट हुआ है।
हेलो।
हाँ जी सर।
हाँ, yes, yes.
मेरी रिक्वेस्ट ये है कि देश क्षेत्रवा अमृत महोत्सव मना रहा है।
बिल्कुल जी, बिल्कुल।
G20 में भी जो है ना, प्रेसिडेंट और प्राइम मिनिस्टर ने हिंदी बोली है, तो हम
हाँ जी,
ये
हाँ
चाहते हैं।
मैडम।
सर, shall I start?
हाँ, yes. उनको सुन लेंगे बाद में वो इंडिया।
Okay, sir. Namaskar and good morning to everyone. Respected speaker today's webinar, Mr. Santosh D. Sir, our chairman, Mr. S.P. members of AVP, esteemed participants, and my senior colleagues. I, Kajal Gupta, manager at DJVF, Divya Jyoti Wellness Foundation, RVO, and coordinator of this webinar, extend a warm welcome to you all in this program. The topic of today's webinar, as you are aware, is practical approach for capital gain. The term capital gain refers to the increase in the value of a capital asset when it is sold. Put simply, a capital gain occurs when you sell an asset for more than what you originally paid for it. Almost any type of asset you own is a capital gain. The capital gain may be short-term or long-term. The capital gain is taxable as per tax laws. It affects the income and tax payable of the seller of the asset. Valuers should be aware of all the aspects in this topic. In this CEP, capital gain and practical approach to it will be discussed in details. The topic is very important as it affects all who sell any type of asset which come in the ambit of concept. Considering the importance of the subject, we have selected the same for the CEP. Mr. Santosh Dev sir is a prominent member of our faculty will be taking this session. Before I hand over the mic to him, I will briefly introduce him to you all. Santosh Dev sir is a chartered accountant and a registered valuer for asset class securities and financial assets. He is advising multiple startups on various issues, including finance, compliances, and fundraising. He is an avid speaker and is a regular at SIRC of ICI, the Institute of Analytics USA, the Institute of Internal Auditors USA, and various RVOs. He has experience of industries both as executive in it and also independent professional. So, sir, over to you for the wonderful learning session for 2 hours. Thank you, sir.
Thank you so much, Kajalji, for giving me that introduction. Welcome everyone for this session. It's a Sunday morning, I understand. It's actually, I'm very happy to see a lot of people who have attended on a Sunday morning. Taking classes is one thing, but attending classes on a Sunday morning is completely a different thing. I don't know. Probably if I have not been a chartered accountant or if I have not been a registered valuer, I don't think I would attend any classes. If I have been in any other profession, I wouldn't have attended any classes on a Sunday morning. But congratulations to you all. You have taken this profession and you are here. And thank you for attending this session. So I'll give you a brief idea about what we're going to do today. So see, this concept of registered valuers is a Companies Act driven concept. So valuation by a registered valuer who is governed by IBBA is a concept from the Companies Act perspective. Now we are all registered valuers from that concept only. Income Tax Act, so far they have not accepted, they have not incorporated the IBBA registered valuer into their ambit. This is multiple times we have talked about it, so I don't want to put it in a slide, show it again to you. So I'm just going to quickly summarize those things. Again, here the registered valuer means a registered valuer under Income Tax Act. There is no registered valuer as per Income Tax Act. Therefore, they borrow it from Wealth Tax Act. I don't know whether you folks remember about 2 decades back, there was an act called Wealth Tax Act, by which act not only your income was taxable, whatever wealth you have accumulated, that was also taxable. So they wanted to know how much was your wealth. Therefore, Wealth Tax Act was prominent then. There, to find out what is your wealth, there was a registered valuer, a concept of registered valuer. In Income Tax Act, today, wherever there is a requirement for valuation, either they go to the valuation officer, who is an departmental officer, or they seek professional help of registered valuers under Wealth Tax Act. But that being said, I want to bring all your attention to certain areas in Income Tax Act, particularly capital gain and other sources, where a registered valuer, in spite of not having any power to do a certification for income tax, assessing officer anyway is not going to accept it. Even if you are a registered valuer under Wealth Tax Act, your valuation report is not binding on the assessing officer. It will be a requirement, but as a professional, as a valuation professional, you will be able to provide certain services to your clients who will be able to use this in their income tax, capital gains, and other sources related matters. Now, I put it in 2 segments. One is where is the requirement, setting up the ground area where we are going to have the discussion. And 2 is the actual discussion. It will be oral discussion between the participants and myself. We will be having a discussion of how we can do the valuation. This is an evolving topic, so it's going to be like that. But the ground area I will set. For now, let us keep it like this. About 45 minutes, we will have the groundwork for capital gains. Then about half an hour of discussion on capital gains related matters. And then I'll go back to another topic. There was a new amendment that came in September 25th, 2023, right in the middle of your tax audits for chartered accountants here. Right in the middle of your tax audits, there was an amendment that came in the other sources where the valuation rules were changed. We're going to discuss about it for half an hour, and last 15 minutes we can have there is no hard and fast rules here. Small, wherever there is, if it is exceeding, we will pull it back and we will be able to cover through. Anywhere, if you feel I'm going a little fast, if you feel that I'm going a little slow, please let me know in the chat. Otherwise, I think Kajal would have noted down your presence. You don't have to put it in the chat box, I guess. Sometimes it gets a little distracting. So if you have already joined, you have joined, that's enough. So anybody you have joined, it will be automatically noted. Now, coming back to the topic, capital gains valuation and Income Tax Act. First, let me go to the basics of capital gains. Before that, I just want to know a couple of things. Number one, how many of you are chartered accountants here or SFA valuers? Predominantly, if you're a SFA valuer, you'll be a chartered accountant, cost accountant, or a company secretary, probably an MBA in some cases. So all 4 of them would already know a little bit of capital gains. It will be a little bit of a revision kind of environment here. But a quick show of hands, how many of you are chartered accountants, cost accountants, company secretaries. You can put it in the chat box so that I can have a broad count. Or you can raise your hand so that I know. Raise your hands as in there is an option to raise your hand. Okay, CA cum lawyer, cost accountant, registered valuer, LNB valuer. Okay, LNB valuer. Okay, so I think I take it is a mix of all three asset classes. So professionals, please you can sit down and have a revision, because I'll tell you, I am a chartered accountant. Before valuation practice, I was a core income tax guy for the past 4 or 5 years. I slowly entered into valuation. Income tax has been my other line of area of expertise. Even now, though I was very strong in income tax about a couple of years ago, half a decade ago, now there are cases that come and I go and represent. Sometimes I read through the law, I find that there are a lot of revisions. There is one section called 54 EC. You will not believe there was an amendment in 17, 18, 18, 19 assessment years, where what happened was they have said that the capital asset that will be allowed for exemption under 54 EC is only land and building. Used to be any asset. You sell paintings, you sell land and building, anything you go ahead and sell, you will be able to claim 54 EC. 54 EC is nothing but your NHAI bonds, power finance corporations, your regional electrification corporations, all these bonds. But what happened was 17, 18, 19, 19, they made a small change. And what happened is you can only invest and get exemption if the core asset is land or building, nothing else. I did not know this. And then in one of the cases, when I was going through, somebody has invested, he has reached out to me. And then when I was going through, I found out that it is not an allowed asset. So allowed investment. So all these things are there. So it will be helpful if you go through one more time. Quickly running through. Okay. Income from capital gains. What is taxable? When is it taxable? So these are the main questions. For the chargeability of capital gains to happen, first you should have a capital asset. Number one, you should have a capital asset. Number two, that capital asset, it should not remain with you. You should have transferred it in the previous year. And then there should be a profit or gain, which is a result of that transfer. So there is a profit or gain, which is resulting out of the transfer. Quick summary, one by one, let us see. First, what is a capital asset? Any kind of property held by an assessee, that is yourself, whether it is connected to business or profession of the assessee or not, it is a capital asset. If there is an asset, automatically by default, it is a capital asset. If whether it is connected with business or profession or not. So then I have stock in trade, etc. There is a separate section which talks about giving exemptions or giving leeway for you to exclude it out of capital asset. We will get there. But for now, any asset is a capital asset. Any securities held by a FII, which is invested in such securities in accordance with the SEBI Act, regulations of the SEBI Act, again, that is an asset. Because sometimes there were some case laws which stated that those were not assets. They had to bring it inside the ambit of capital assets. So they have brought it inside separately, exclusively. Now, what are all exclusions? Now, I've told you what are all the capital asset. Oh, I have to get a newer version. Just one moment. Just wondering why the order is not coming properly. The order is not coming properly because the latest version I have not saved. Now. And now you should be able to see the newer version. I think we'll have a smoother.
Sir, ask everybody to mute their line. Sir, ask
Yeah,
everybody
please.
to mute, sir, please.
Yeah, sure. Please, if you have anything, please raise your hands and you can talk. But otherwise, please keep your mic muted so that it's not disturbing others. So let's move on. Right, capital asset. And what are all the exclusions? Sir, you said everything is in capital asset. Then if I have something in my business, if I'm selling in the course of my business, then it will also become, will it also become a capital asset? No. So there are exclusions that are given, which are not capital asset. Number one is stock in trade. Immediately to answer the question, if I have goods, if I have mobile phones, I am selling it in, I have a mobile shop, I have mobile phones, I'm selling it. Will it become a capital asset? No. It is charged under business or profession, therefore that is excluded. There are specified bonds and special bearer bonds which are specified by the government. Whenever there is a need, they go on to liquidate the gold from the individual hands and they take it to the government and they issue bonds. Those kinds of special bonds are excluded. Rural agricultural land is excluded. Gold deposit certificates are excluded. Personal effects are excluded. So pretty much this one special specified gold bonds is a special area. Special bearer bonds is a special area. Gold and deposit certificates are special area where the government is saying if these are all, when there is a requirement, they would have bought the gold. They would have taken deposits for buying gold. Those are excluded from capital asset. But what we usually see is stock in trade. Number two is your rural agricultural land and the personal effects. Stock in trade is self-explanatory. I'll go in detail in only two cases, rural agricultural land and personal effects. Number one, rural agricultural land. Sir, I know agricultural land. Okay. I don't know how I got on mute. How I got muted. So, what is rural agricultural land is the question. Agricultural land that is in India, not being situated in specified areas, is rural agricultural land. This is the direct text from the Income Tax Act. I'm going to take you to a little watered down version where you can quickly understand. If that land is situated in a municipality, notified area committee, town area committee, cantonment board, which is having a population of not less than 10,000, which is, when they are saying not less than, it's more than 10,000. If you are living in a municipality or other areas, which is having a population of 10,000 or more, it becomes automatically an urban agricultural land. If it is within the following distances, not only in that particular place, let us say you are in Bangalore. In Bangalore, if Bangalore is a municipality, if it is a notified area committee, town area committee, cantonment board, which is having a population of more than 10,000, immediately that's an urban agricultural land. Not only that, if you are living in, say, about 2 kilometers from that particular place, and the place that you are talking about, the 2 kilometers from, that place has 10,000 or more population, not exceeding 1 lakh, then again it is an urban agricultural land. You're in, let us say, Bangalore, and if somebody is in Hosur is say 2 kilometers. I don't know. I have not measured. I'm just giving you broad idea. If it's 2 kilometers from Bangalore, and that Bangalore has about 10,000 to 1 lakh population, then if you are within 2 kilometers from that particular place, automatically it is an urban agricultural land. 6 kilometers from a place which has 1 lakh or 10 lakh population, urban agricultural land. If it is 8 kilometers from a place where it has more than 10 lakh population, it is an urban agricultural land. These are all urban agricultural land. Exemption or exclusion does not apply. Even if it is an agricultural land, if you are in Bangalore, if you do even cultivation, if you sell it, then automatically capital gains will apply. But if you are, say, in a very remote village where surrounding 8 kilometers, there is no municipality, notified area, or town area committee or cantonment board, where the population is more than 10 lakh or not even more than 10,000, then automatically it is a rural agricultural land. If you buy or sell that particular rural agricultural land, you will not be having any capital gain impact. If you buy it for 10,000, you try to sell it for 1 lakh rupees, 90,000 rupees is not a capital gain. You will not have taxation not because of an exemption, but because of an exclusion from the capital asset definition itself. Number two, the second thing that I said I will talk about is the personal effects. What is the effect, sir? Personal assets or your personal effects, whatever you use for your personal purposes, that is excluded from the capital asset definition. But people started, obviously, they started using it for their own purposes. Jewelry, they started buying and selling jewelry. They said it's a personal effect. Therefore, they said exclusion is only to personal asset, but not to jewelry, archaeological collection, drawings, paintings, sculptures, any other work of art. So there was one beautiful case where I told you, I think we were talking about it. There was a painting by M.F. Hussain. This person, my assessee, he has bought it and he has kept it for almost 30-40 years now. He has sold it for about a couple of crores. He has sold it in the market. Now, one thing that he said was, I kept it in my hall. It was it was covered with glass. It was secure, and it was a personal asset for me. Why should I pay taxes for it? Specific exclusion is there. Drawings, paintings, sculptures, archaeological collections, jewelry, and all. Exclusion to the exclusions. Therefore, these jewelry, archaeological collection, etc., will become a capital asset. Therefore, if you sell it, there is a capital gain. Now, quickly let me recall the concept. Capital assets are taxable under capital gains. Under capital asset, there were six items which are given as exclusions. Of that six exclusions, specified gold bonds, special bearer bonds, gold deposit bonds are issued by the government. Therefore, they have excluded it. Stock in trade relates to business, so that is excluded. Rural agricultural land, government wants to exclude it, and personal effects are excluded. But in personal effects, all personal effects are excluded except for these five items: jewelry, drawings, paintings, sculptures, or any other work of art. So essentially, what I'm trying to say is, in case if a valuation need arises, I'll tell you where the need arises. In case a valuation need arises, other personal effects, there is no use of valuing because they are exempted. Let us say you have an used car. It's a motor vehicle. It's a personal asset. It's not a business asset. Remember, if it is a business asset, then automatically it will become a depreciable asset. It will become taxable. But if you are using a personal car, you bought a car for your own self. If you bought a two-wheeler for your own self, for your personal consumption, not for business, and you sell it, you bought it for 5 lakhs. For whatever reason, you sell it for 6 lakhs or 7 lakhs because of price hike in the market. For whatever reason, you are selling it at a higher value. Will it become taxable under capital gains? No, that's the idea. So if you as a valuer, we don't have scope there. But as a valuer, we have scope in all these areas. Jewelry, archaeological collection, drawings, paintings, sculptures, any work of art, we have scope, do valuation. That's the point I'm trying to drive. Same goes for agricultural land also. Urban agricultural land, we have scope for doing valuation. Rural agricultural land, it is exempted or excluded. It's not exempted, it's excluded. Therefore, we don't have scope for valuation. Because when it comes itself, basics, if you know, you don't have to do the entire valuation and then get to know that the entire thing was excluded. Therefore, the entire valuation report is not needed. So that's the idea I'm trying to get you here. The sale, or what is a transfer? Now, I told you what is a capital assets. Capital assets are when you sell it or if you transfer it, it's going to become taxable. Now, what is transfer? Transfer can be any of these 8 categories. It can be sale, exchange, or relinquishment of the asset. It can be extinguishment of any right in relation to a capital asset. If you are extinguishing the right to possess it, then that itself becomes a transfer. Compulsory acquisition of asset. Sir, I did not transfer. Sir, the government came and compulsorily acquired my property. They said there is a road that is coming and therefore they had to buy my property. And I did not agree to it, but still they have acquired it. Compulsorily they have acquired it. I did not transfer. Still, for the purposes of Income Tax Act, it is a transfer. Conversion of capital asset into a stock in trade. The moment you have large land parcels you have in your hand, you have decided you are going to use that the agricultural or non-agricultural land, you're going to put it into plot, try to sell it in the market. You have decided that. You have taken the necessary permissions and you have made it into plots and you have sold it. Now, when it is taken as stock in trade, the date on which you are transferring the capital asset into stock in trade, it becomes a transfer. Pay capital gains separately. And then for the sale of the plot, whatever is the rate at which you have calculated the capital gains, the sale consideration calculated, that will become your cost of acquisition of that stock in trade. From there, you can calculate your business profit or loss. Now, maturity or redemption of zero coupon bonds, that is a capital gain. Allowing possession of immovable property to the buyer in part performance of a contract, capital gains. any transfer, any transaction which has the effect of transferring an immovable property, that again that is a transfer, disposing of or parting with an asset or any interest therein, or creating any interest in any asset in any manner whatsoever. All these are transfers. Even in the case of intangible assets, if you have decided, if you created a brand and you have decided, I am going to relinquish my rights of this particular brand to this particular party, I am not transferring it. I am just saying that I will not take any action and I will not make any claims on that particular intangible asset. Still, that will become a capital asset and it will become a transfer of capital asset. Now, not transfers, I'm not going to go into the depths of it. To give a flavor of it, I'll just take a few cases. In case if there is a business and the business decides, okay, boss, I'm going to close down the company, I will liquidate the company. That's not a transfer. HEF, if it dissolves it, it's not a transfer. If somebody gives a gift, though it is a transfer, I am gifting my son my entire property and gifting it to him, it is not a transfer because it is gift, it is covered under other sources provisions. So these kind of items where there is an actual transfer of the asset in the grammatical sense of it, but it is charged under a different head, or it is already it is a vehicle, and the assessee is a vehicle, and through the as a vehicle it is being distributed to the beneficial owners. Those will become non-transfers. There are 42 different cases for it. I will share this PPT with you. You can slowly go through. Quickly, long-term versus short-term. How do you calculate what is short-term, what is long-term? Listed securities, units of UTI, units of EOF, and zero coupon bonds. These are all your if they are held more than 12 months, they are long-term. Held less than 12 months, it's short-term. UTI and Unit Trust of India and equity-oriented funds. This is the explanation for UTI and EOF. EOF and UTI, listed securities and zero coupon bonds, 12 months. If you hold for 12 months, it becomes long term. If there is unlisted shares or immovable property, you should hold more than 24 months. If there is any other capital asset, you should hold more than 36 months. Sir, what is the reason we are having this long-term, short-term calculation? Multiple benefits are given for holding an asset for a longer period, which is long-term. Indexation benefits do come. Then there are benefits of, in case if you are holding on to shares and securities, your rates will be lower. All these benefits entail if you are holding it for the long term. In the case of short term, actually the rates is your normal income tax, whatever slab rate that you are in, it will become that will be the rate. But when you go to long term, it is hardly 20%. In case of indexation, if you don't even take indexation, that is 10%. So that is there, you'll have to keep in mind. Now, capital gain, what is this? Depreciable assets. Now, I've given a broad idea about long-term, short-term. There is one peculiar area which I want your attention to be drawn towards, which is called the depreciable assets. What are depreciable assets? Assets which are used in your business. And you have a table called the depreciation table, where fixed assets pick their numbers from. That place, the depreciable assets, that place you will have the assets, these are all the depreciable assets, where as per Companies Act, you will charge the depreciation. Also, as per Income Tax Act, you will be charging a depreciation. Companies Act, it is an individual asset basis. There will be individual assets, and for each asset, what is the useful period, you will be calculating based on return down value method or straight line method, whatever is the method that you are following, you will be calculating the depreciation. For Income Tax Act, there is a peculiarity. There is the concept of block. There are multiple blocks that are there. Each block, the assets are not separated. They are clipped together and it is kept as a single block. They act as one unit by itself. So what happens is, usually capital gains arise from capital gains do not take part in businesses. Usually it is excluded. Stock and trade, it is excluded. Same way, fixed assets which are related to business, why should I bring it in here, sir? Usually it is not there. In case if you are having a particular asset block, it is worth 1 lakh rupees. You are selling something from that block for 10,000 rupees. So essentially what you will do is, from that 1 lakh rupees of block value, return down value, you will reduce the 10,000 rupees and 90,000 you will carry forward. This is what we will do. Usually what happens is, times when the entire value of the block is consumed because of the sale. The block value, written down value is 1 lakh rupees, but you have sold one asset from that block for 2 lakh rupees. That's an excess of 1 lakh. 1 lakh you will reduce from the block. Baki 1 lakh, what you will do, it cannot be taken as business income, it is a capital gain. Same thing goes if the block has 2 assets. You have 2 cars. The 2 cars are the only assets in that block. Now you go, the entire value is say 1 lakh rupees, but you have sold it for 50,000 rupees, but you have sold 25,000 rupees each car. So 25 into 2, there is 50,000. The block is there. The value is there. 1 lakh is there. Even 50,000 is reduced, you still have 50,000 rupees balance. But there is no asset in the block. The entire asset has been hived off. There also automatically capital gain, in this particular case, capital loss comes into play. So 2 scenarios. One, if the block's value becomes less than 0 or 0, or if the assets in the block has been reduced, it has been taken. So these are the 2 scenarios you'll have to keep in mind. When on the last day of the previous year, WDV of the block of asset is nil, or when on the last day of the previous year, block ceases to exist because all the assets in the block has been sold. Even though there is some value, it will be booked as capital loss because the asset itself is not there. You cannot carry it. So I hope depreciable assets is understood in case, because that is one peculiar area we will have discussion here. In case if you don't understand, you can let me know. Now, how do I compute capital gains? Usually, short term is pretty straightforward. What is the full value of consideration you have received? Total value of consideration we have received for transferring the particular asset. Reduce any cost of acquisition that you have. Reduce any cost of improvement, and reduce any expenditure in relation to the exclusively for that particular transfer. Let us quickly take an example of a land. You bought a land about a year ago. You sold it now, and you have received 1 crore rupees. 1 year before you bought it for, so let us say 70 lakh rupees. So 1 crore is the full value of consideration. You reduce the 70 lakhs of cost of acquisition of the asset. Apart from cost of acquisition, you have also done some compound work amounting say 5 lakh rupees for upkeep of the premises. That is your cost of improvement. 70 lakhs plus 5 lakhs, that also needs to be reduced. 1 crore minus 70 minus 5. Then there will be obviously a commission agent who facilitated the transaction. He came and he asked for 1% commission, which amounts to 1 lakh rupees. That also can be reduced. Therefore, 1 crore minus 70 lakhs of cost of acquisition minus 5 lakhs of cost of improvement minus 1 lakh of expenditure incurred and wholly in connection with such transfer, all this can be reduced. The remaining 24 lakhs will be charged as short-term capital gains in the hands of the assessor. Straightforward case. From here, we will build on to the long-term capital asset. In the case of long-term capital asset, we will reduce the same expenditure incurred wholly and exclusively in connection with the transfer. We will reduce that. That is there. But with the regard to the cost of acquisition and cost of improvement, we are going to use something called indexation. What is indexation? One slide later, I'll explain. Indexation is nothing but, so to be simply put, sir, in long-term capital asset, sir, I bought it a decade ago. If I remember right, the place that I'm sitting in, this particular land, we bought it somewhere around 2001 or 2002 for a rate of somewhere around 3 lakhs or 4 lakhs. And today it is worth about, it is definitely worth more than a crore, 1.1, 1.5 crores. So it has appreciated so much. But is it entirely capital gains? No. That 1 lakh, if I had at that point in time, how much of gold I could have bought, how much of, leave alone gold as an investment. I could have enjoyed the benefits of buying fruits, vegetables. I would have done a lot of things. One apple was hardly 5 rupees then. Today it is 20 rupees, 30 rupees. That cost inflation is supposed to be taken into account. That is why the cost inflation index was introduced. So we go on to find out what is the value of that particular money in today's terms. We reinstate based on inflation. That is your indexation. We'll come there. Finally, we come to depreciation. Depreciation, this is a very peculiar way of calculating the capital gains here. Here, negative value means capital gains. That is something that you'll have to keep in mind. Why? Because income tax prescribes so. Because this is not directly from capital gains. It is under section 50. with relation to your business income or losses. They have linked it to section 50. What section 50 says? You take the WDV of the block at the beginning of the year. Any current assets that, any assets that you have bought in the current year, you add it to the WDV block. So 1 lakh of WDV as of the beginning, you have bought assets worth 1 lakh rupees in the current year. 1 lakh plus 1 lakh, 2 lakhs the block's total value. Now you go on to reduce the value of the consideration that you have received for making a transfer in that from that particular block. If say, if you have received or 1.5 lakhs, that 1.5 lakhs, 2 lakhs, if you reduce 2 lakhs minus 1.5 lakhs, you will be getting 50,000 rupees of WDV balance in the block. It's a positive value. You carry the block at 50,000 rupees, provided there are other assets in the block. Let us say there are 4 assets in the block. Current year, you've got one more asset, 2 plus 1, 3. 1 plus 1, 1 lakh was there in the beginning. 1 was bought in the current year. 1 plus 1, 2 lakhs of the total value of the block. There are 4 plus 1, 5 assets now, of which you have sold only 1 asset. And that asset is worth 1.5 lakh rupees. 2 minus 1.5, you will be receiving 50,000 rupees. That will be the WDV of the block. There is no capital asset or gain. Why? Because the asset value has also not become nil. WDV also has not become nil. As well as the block has multiple other assets also. Of the 5 assets, only 1 is sold, 4 other assets are there. Now, take the other example, where the asset being sold is worth 2.5 lakh rupees. What happens now? You have 4 more assets in the block, but the value has become 2 minus 2.5, negative 50,000. This negative 50,000 will be charged to capital gains, not as a business income. It will be charged to capital gains. That is the point that I'm trying to write. So in case if there is a positive value from this calculation, it will be carried in the block. There is a negative value, you'll have to take it to the capital gains. Sir, then there is no possibility of capital loss. Yes, there is a possibility of capital loss. There is 4 assets plus 1 asset. 5 assets are there. 1 lakh plus 1 lakh, 2 lakhs. You're not able to sell all the 5 assets for even 2 lakhs. If you are able to sell it only for 1.25 lakhs. All 5 assets are sold, but you are able to get only 1.25 lakhs. The remaining 75,000, which is there in the block, as per calculation, it is there. The assets are not there. The block itself has ceased to exist. That 75,000 will be capital loss. So that is something that you'll have to keep in mind. Now, quickly running through, how do you calculate the cost of acquisition? This is where your practical concepts will start kicking in. If the asset that you have bought, I'm not going to go into Manjula Shah, I'm not going to go into other case laws. I'm just going to be plain and simple here. If you go ahead and you buy a property, it will in your own name, then you can take whatever value you bought the property for. In case if it has come to you through will or inheritance, then you don't have a proper, you have not paid anything to get that particular asset. Therefore, the value will become 0. No. If you have taken it by will or inheritance, it has been passed on to you from somebody, even through gift, it has been passed on to you through somebody, then what happens is you can go on to take the cost of acquisition of the previous owner. Your father bought the property for 1 crore rupees. He has transferred it to you for, he has transferred it to you. There is no cost, obviously. Through will, you have got it. Then, sir, I have got it only through will. Therefore, no cost of acquisition for me. Not like that. You can take the cost of acquisition of your father. Also, for the purpose of calculating the long term or short term, the period, not only the period that you are holding it, the period from the date on which your previous owner was holding it, that can be taken into consideration for calculating long term or short term. Yes, sir. Narendra, sir, you have raised your hand.
Sir, what is meant by WDV?
Written down value method, sir. WDV means written down value. Usually, when we buy an asset in business, what we will do is we buy it for 100 rupees. Then every year we will charge a depreciation for it. Let us say 10%. 100 rupees will become 90. This 90 rupees is called the written down value.
Sir, WDV and WDV and book value are the same?
Yes, correct.
Okay, sir. Thank you.
Yeah. So book value, it is the same, provided you don't look at, say, sometimes in companies, book value is as per depreciation is as Companies Act. But you'll have to see WDV as per Income Tax Act. It is also book value. That will also be recorded. It will be there in the books. But it is WDV as per Income Tax Act depreciation rates, not the Companies Act. If you purely see book value, then sometimes what happens is we misinterpret the value that is reported in the balance sheet, which is as per Companies Act. You should ask for a separate sheet that they maintain in the income tax returns and all they will file, where the depreciation as per income tax is applied. So 100 rupees asset in Companies Act, they will say 20% you claim depreciation, but Income Tax Act, they will say only 10% you claim depreciation. So you should take the written down value as per the Income Tax Act. Right. Now, where was I? Yeah. So if you understood the concept of taking over from another person through gift or inheritance, you can use the assets cost of acquisition from the previous one. You borrow that cost of acquisition, you borrow also the period. It got through will to you only for 1 year before, it will not become short term. If your father has held it for more than 2 years, so total 2 years or 3 years has passed by, therefore you would have the benefit of long term capital gains, indexation benefit and all will apply. Now, if the asset became the property of the taxpayer after April 1, 2001 by way of gift, will, etc., in mode specified in section 49(1), cost of the acquisition of the previous owner can be taken. This is the concept I explained. If the asset became the property of the taxpayer after 1 April 2001, self-acquired property, I only bought it, sir. Your cost of acquisition you can take. Now, if the asset became the property of the taxpayer before April 1, 2001 by gift, will, etc., in mode specified in 49(1), then what will be the cost of acquisition in case of acquisition of properties before 1st April 2001? The income tax department gives you an option. Actually, it's not an option. They are saying whichever is higher. It is ideally an option where cost of acquisition of the previous owner can be taken, or fair market value as on 1st April 2001. Whichever is higher can be taken. Now, this is the area where so far for the last half an hour, whatever we were discussing, this is the area that is of relevance. Now, as a valuer, we have the professional work of taking up this kind of valuations. One peculiarity is usually we go on to do the valuation as on today. We go to the place, we look at the place and we value, okay, today this particular place is worth 1 crore rupees or 2 crore rupees, land and building or plant and machinery. We go on and value. But in this case, you'll have to do the valuation as on a prior date, not only any prior date, it is about 2 decades back. 2 decades back, this particular land or building is worth how much is something that you have to value. If you can value that in a scientific manner and give a report, it's not binding on the assessing officer, but it will form part of his records. When the assessing officer goes through the records, he will know that there is some presence of mind, some mind has been applied in calculating this fair market value. Therefore, it will strengthen the case for the assessee. He will not be able to do it by his own self, but us registered valuers can help him and give a report and strengthen his case. Same thing applies if the property became the property of the taxpayer before April 1, 2001. In his own self, he has bought the property. Still, fair market value as on 1st April 2001 or the cost of acquisition, whichever is higher, can be taken. And this cost of acquisition, it can be taken for the purpose of indexation. I will come back here. We will finish cost of improvement also. In relation to goodwill or business, right to manufacture, there are certain areas where you cannot take cost of improvement. In relation to capital asset, which became the property of the assessee or previous owner before 1/4/2001, any expenditure of capital nature incurred on or after 1/4/2001 only can be taken. Why? Because we are calculating, we are given the option to calculate what is the fair market value as on 1/4/2001. Since you bought a property, all the improvements that you've done, it has been already factored inside that fair market value. They don't want to take any duplication of expenses again. So that is not allowed. In relation to capital asset, which became the property of the assessee or previous owner before 1/4/2001 by way of any mode specified, again, your previous owner's cost of improvement can also be taken, but it cannot be taken before 1/4/2001. In relation to capital asset, which became the property of the assessee or the previous owner on or after 1/4/2001, you can take all the expenditure that has been allowed. Now, this is a crux of what I wanted to convey. Now, what is indexation? Quickly, In case of transfer of a long-term capital asset, indexed cost of acquisition and indexed cost of improvement shall be deducted. In the case of a long-term item, this is the benefit. You will get indexation. Indexed cost of acquisition, indexed cost of improvement shall be computed with the cost inflation index. Any index cannot be taken. CII index, which is the cost inflation index, should be taken. Who publishes cost inflation index? Income tax department, they have a table where they give index. It used to start from 1981. Then they thought almost 4 decades have passed. Even registered valuers trying to figure out what was the value 4 decades back will be next to impossible, leave alone the assessing officer. Therefore, they have decided nothing doing. We are moving it 2 decades forward to 2001. Yes, Prashant sir.
There's one query.
Yes, sir.
I'm a land building valuer. I got an assignment for capital gain tax computation. What had happened was that this year of change of year from 81 to 2001 has occurred, I think, in 2017, I believe.
Correct. Correct.
Right. So now this person got the notice in 2016, and now he has to file the reply. I don't know why he delayed this much so much. So the question was whether I have to value the asset as on 1st April 2001 or 1st April 1981. That was the question.
In the assessment year 2016, automatically 1981 valuation only will apply.
Okay, so I have to give the valuation for 81, right?
Correct. 1981.
Right.
Indexation also ideally we should not take this indexation. Till 2016, there was a different index table that was there. Index table should be taken.
Okay, sir. Okay. Thank you so much.
Yeah, sure. So quickly, let us see how the computation of indexation works. You take the cost of acquisition, you take the cost of improvement, you divide it by the base year's cost of base year's CII index. So base year 1981 used to be 100, and then from there they used to calculate the index. Now they have shifted it to 2001. The moment they shifted it to 2001, 2001 will become 100. The index 2001 become 100, and from 100 onwards, now I think it's 362, 364, somewhere in that range. 2023, it has become 364. So if I have spent 1 lakh rupees in 2001 or 2001, I will divide that 1 lakh by 100 and I multiply it with 362 or 364, whatever is the current inflation index. So 1 lakh will become 3,62,000 or 3,64,000 based on the index value that I'm trying to. Anybody who wants to quickly check what is the index now? That will be a good exercise. Go to income tax website. CII. Let me see. Oh. Cost inflation. Yes, sir. How much is it?
You want?
Current year, 2023.
1 second. 2022-23 is 331.
331, 22, 23, and 2023, 24 is provisionally 248.
348.
Okay, thank you. So 348 is the index value. So if I bought some value for some asset for 1 lakh rupees in 2001, the government is saying, irrespective of how much ever it has grown today, the cost inflation that we are seeing is 3.48 times or 348 index points. Therefore, divide by 100 into 348. 1 lakh divided by 100 into 348 is 3,48,000. That particular asset is worth 3,48,000 today in cost terms. You sell it for 1 crore or 2 crore, whatever is the difference, you pay taxes. That's the idea. Same thing applies for improvements also. Base year was moved from 1981 to 2001 with effect from assessment year 18-19 onwards, which is financial year 17-18. Thus, if any capital asset acquired before April 1, 2001 is transferred, then assessee has an option to take its cost of acquisition either a fair value as on 1st April 2001 or its original cost. Sir, fair value, I don't know, sir. I don't want to take risk and all. 2000 only, 1991 only I bought that particular asset. Not much would have changed. I will take the cost of acquisition itself, sir. I bought it then itself for 2 lakh rupees only. Probably if I put fair market value also, I will get hardly anything. I will get say 1.1 lakhs or 2.2 lakhs. I don't want to take the risk. I will go with 2 lakhs itself. It's at your option. You can go ahead and give 2 lakhs. I say the assessing officer will not go and fight with you because he is not ready to save you. He is ready to save the interest of the government. So that's where we stand on indexation. Now, rates of taxes, we finish rates of taxes also. Complete capital gains. Give me a couple of minutes more. We'll finish this and we'll get into the discussion point. Now,
Santoshi, before going that, one practical question I will ask you about this calculation, whatever we now dwelt it.
yeah, please, sir, go ahead.
Give me 1 minute time, I'll tell you. It is my
Yeah.
it is my personal case only. Of course, there is some disputes are there. That's why I just want to take your guidance since the subject is relevant to that.
Sure, sure.
During 1989, I purchased one site of 150 yards. 1989. Subsequently,
Okay.
I built a house on that. And
Okay.
2003, I given for development. I got 2 flats. In 2016, the 2 plots I have given to my daughter as a gift. Now, my daughter has sold it to somebody. Now, she wants to have a capital gain tax. Now, there are several chartered accounts, of course, my friends also. They'll be telling a different versions. Now, that subject has come because it will be useful for other people also. I think there may be some people of my age group people there. In that way, I just want to know, since what they are telling now, 2016, when I gifted to that, now 2023, she sold it out. What they say, 2001, what is the actual value? They want to take it out. And government says, no, that's valued only 3 lakhs at the time. You can put it at 3 lakhs and go for cost of index, you can put it like that. Even that also, if I make, no, sir, it is almost, she has to pay some 6 to 8 lakhs of capital gains. My doubt is that since I give for development 2003. Subsequently, I incurred certain expenditure in developing the plots also inside, furnishing all the things. And after 2016, when I gave to my daughter also, she also kept for beautification of the premises. These 2 things are there, but I don't have any exact expenditure items. I cannot show you those things to either income tax authorities or myself, because I knew that I incurred expenditure. If that expenditure are 2 stages expenditure, that is before giving the gift, after of the giving gift, these 2 expenditure can I take into account and account for computation of capital gain tax?
Sir, with regard to Income Tax Act, number one, let us be very clear. It is allowed. Any expenses that you make into your flats, it's 100% allowed. But whether you have actually made the expenditure or not, the income tax officer would know only based on proof. We know that we would have spent it, but if you can scrounge through your documents, find out some proof of doing so, give us of paying some interior decorator or making any payment to any contractor, if you can find proof, definitely it is allowed. But if there is no proof, then it is your word against the assessing officer's word. Obviously, the assessing officer is not going to accept because he has to put it in a file. He has to create a file for your assessment year and for the assessee. They will not be inclined to accept it. So if you have a proof, 100% you can claim cost of improvement. It is the very similar case to what we have been talking about. Before 2001, whatever you have done, it's not at all allowed. But after 2001, all the expenses that you have made, 100% it is allowed. In fact, if you have made any payments to the builder, apart from the land that you have given, if you have made any payments to the builder, that also is allowed because it's an exchange transaction and you have paid more. There is a transaction and you have got flats for when you have relinquished rights to part of your land. That itself is a transaction. You can take in excess payments that you have made, you can take benefit of it. But only thing is you need to have proofs.
Yes, without proof, I'll not be able to do much about that. That's the thing.
Yeah, without proof, officer is not going to accept. You can claim income tax return. You can claim. That's not a problem. The return will allow you to file that claim without any problem. But the officer, in case if it is taken for scrutiny without documentation, it might not be allowed.
Okay.
Sir, I have
I have a question. I am Satish Bogra. I have
Yeah.
a question.
Yeah, go ahead.
To get to the 2001 value, can we use the present value of rupee concept? Suppose I have, market rate available for say 2021. Can I use this market value and the present value of rupee? Because I have this trail of the cost index, inflation cost index for the past say 20 years. Can I average it out and use the present value of rupee concept to bring it to 2001 datum and then inflate it with the available cost index of the present year to arrive at the indexed value? Can I do that?
Okay. I'll hold on to this question for another 5-10 minutes. We'll finish this rates of taxes and we'll go there because it's an open discussion where this question is one of the questions that I was anticipating that would come. We will hold on to that thought. We will go to once we finish the rates of taxes, we will go there and I will answer your question, Satish sir. Yeah, Vinit sir, please go ahead.
Yeah, good morning. It is connecting to what Nagesh Babu sir had just said. So let's say a customer is saying that I have incurred maybe say 5 lakh rupees on improvement of my flat. From 2001 to maybe 2005, I have incurred these expenses, but he doesn't have any proof of it. But he asks me to include those costs in my report. Can I include that cost in my report? Can I include that particular expenses that the customer is claiming to have incurred? Can I mention it in my report?
So if you are doing valuation after 2001, the point itself is what is the value as on 2001? So those expenses wouldn't have occurred in 2001. Therefore, you should exclude it. There is no point of including them. But if you have certain expenses that were incurred before 2001, he is saying that this compound wall was built before 2001. And if you go and physically verify, there is a compound wall. There is a compound wall that is there, and he is saying that he has built it before 2001. Assume it is in case. See, only thing is it should not be replicated. He cannot say that the compound was there, wall was there before 2001. When he is submitting to the income tax officer, says that cost of improvement 2001, after 2001 only I built the compound wall. He cannot do it both. As long as he doesn't do that, you can include all the cost of improvements that are there previously before 2001, whatever is there, you can include it. One physical verification is required for you to go and check, oh, is it a 20-year-old compound wall or not? You should check. Or if it is a building improvements, have they actually done it before 2001? Is something based on common sense and logic you can figure out. Otherwise, I think after 2001, you cannot have.
And
No, I have a rejoin. I
Thank
have
you.
a question in this
Yes,
context only.
Yeah, go ahead, sir.
Can I speak?
Yeah, please,
Yes.
sir.
I have a additional question to what this gentleman was referring to. You said that since in 2001, there was no, existence of the additional expenditure done or raising of a boundary wall or improvement or whatever. Supposing he has come about to do the improvement in the year, say 2005, like he said. So the expenditure incurred, I have proved everything. Suppose the income incurred in 2005 is to be included in the overall scheme of things. He can very well take the benefit based on the difference of the cost index occurring today and in 2005, other than from 2001, because after indexation is done from 2001 itself. So he can take this effect from 2005, reducing that index quotient in a proportionate way.
Okay. See, Satish sir, I will give it to you that you are using income tax weapon against themselves. The cost inflation index is not a very good measure. If you take 1 crore rupees property today and you divide it by 348 into 100, you are saying that particular property is worth somewhere around 50 lakhs, 60 lakhs in 2001, which is not the case. Everybody knows that the fair market value, the circle rates, guideline value, all that will come into play. So ideally, the income tax officer will not agree to it, but he will hold to it for a couple of minutes more. This is also related to your previous question. We'll hold it for a couple of minutes more, 5 more minutes. We'll finish this and we'll go there. There are certain, it's not a hard and fast rule. This is one way we can go about it. Definitely, you can go ahead and say discounted based on today, this is the value. I discount based on this particular percentage of growth and I can arrive at that value. But whether it is scientifically, whether it will be accepted by the assessing officer is something that is questionable. We'll come there. Give me 5 minutes, finish this, we'll go there. Now,
okay, sure.
Yeah. So, quickly, we were in the middle of rates of taxes. How do you go about with rates of taxes? Short-term capital gains usually is the more punishing part. When you compare long-term and short-term is the more punishing part. All your depreciable assets, when they encounter, because of there are 2 cases, when they encounter capital gains, they come under short-term also. So short-term capital gains of the normal assets and depreciable assets come under short-term capital gains. It shall be included in the gross total income of the taxpayer. Normal rates of taxes will apply. You are in the 30% slab. If you have short-term capital gains, usually 30% will become applicable. It will be added to your normal rates. It will be added to your gross total income. Normal rates will apply. Short-term capital gains arising from transfer of equity shares, units of equity-oriented funds, which is UOF, or a unit of a business trust, which is chargeable to securities transaction tax, shall be taxed at 15% under section 111A. This benefit is being given 15%. Usually it is whatever slab rate. If you are in 5% slab, you scheme 5% slab, 5% only. But you are also given a benefit if you are in the higher slab rates. If you are trading in equity, UOF or units of a business trust, you can take that 15%. Now, benefit of reduced tax of 15% shall also be available with respect to units of business trusts which were acquired by the assessee in lieu of shares of a special purpose vehicle. There also this 15% is accepted. Quickly moving on to long term. Long term, usually the rate is 20%. This is something that we'll have to keep in our mind. Usually it is 20%. Only in the case of listed securities, units or zero coupon bonds, if you are taking indexation benefit, 20%. If you don't take indexation benefit, it is 10%. Usually what happens is we go for this 10%. Indexation and all will not work. Usually if we are getting a capital gain, we would have held that share, and that share will go to Nifty and look at how the index has zoomed from 1,000 points to 18,000, 19,000, 20,000 points. So that much indexation will not help you. Therefore, usually 10% is what we will take. One more thing that you'll have to see is there is 1 lakh exemption that is given. If you make long-term capital gain of up to 1 lakh rupees through equity shares, unit of equity-oriented funds or unit of business trust, up to 1 lakh rupees, it is exempted. After that, it is chargeable. Sir, I am getting 1,10,000. Because I have exceeded 1 lakh rupees, my entire 1,10,000 will be charged? No. Up to 1 lakh, anyway, it is exempted. The remaining 10,000 only will become chargeable. Long-term capital gains arising to a non-resident or a foreign company from transfer of unlisted securities shall be taxed without giving the benefits of indexation. NRIs, indexation benefit has been removed. Now, there are cases where the valuation will be referred by the assessing officer to the valuation officer. We'll finish this and we'll have a discussion. When will it be moved? With the view to ascertaining the fair market value of the capital asset, the concerned departmental assessing officer may refer the valuation of capital asset to a valuation officer who is a government officer, the income tax department. In the following cases, where the value of the asset as claimed by the assessee is in accordance with the estimate made by a registered valuer. Who is this registered valuer? Your wealth tax registered valuer. But the assessing officer is of the opinion that the value so claimed is at variance with the fair market value of the asset. So I am saying that the value is 1 lakh rupees. The registered valuer with whose help I have taken, he has taken a license. He has also agreed it is 1 lakh rupees, but the officer is saying no, it is worth only 20,000 rupees or 30,000 rupees, whatever it is. He can refer it to a valuation officer. He will be determining, and that is binding. The registered valuer's report is not binding. Valuation officer's report is binding. Where the assessing officer is of the opinion that the fair market value of the asset exceeds the value of the asset by more than 25,000 or 15% of the value claimed by the assessee, whichever is less. Where the assessing officer is of the opinion that having regard to the nature of the asset and relevant circumstances, it is necessary for the necessary to make a reference to the valuation officer. Essentially, it is at the discretion of the assessing officer to refer. If he wants to refer, irrespective of all these things, the third point, he will say that this asset requires, the circumstances require a valuation officer to take a look at this particular asset. Then automatically it goes to the valuation officer. Now with this, we will stop the discussion. I think 45 minutes. It took about an hour. Sorry about that. Let's go ahead and discuss the point, the elephant in the room. Sir, this is all theory, sir. What is the major point as a valuer I would want to understand this part? 2001. Yes, sir. Go ahead.
Shall we take questions now, John?
Shall we?
Shall I ask you a question now?
Now it is open for all. Not only questions, answers are also welcome, because I am not a land and building valuer. So different views. This is one of the views I was expecting using capital cost inflation index to go ahead and do it.
I've been waiting for this opportunity. Actually, when they are going to put this capital gains like the subject, I'm saying luckily I got today. And supplement to my previous questions also. Since I gifted my property to my daughter, and my daughter is putting straight away two questions, sir. One is, since you gifted me in 2016, why you wanted to go back to calculate capital? Because since he's ready to pay capital gains, why they wanted to go for calculation of previously 1/4/2001? That is, of course, income tax rule says, but I'm not able to answer my daughter. Second question, since it is gifted the property in the year 2016, when the document says about market value of some so amount, why not to take that market value into account so that based on that I'll pay, ready to pay that amount? These two things, nobody is taking care of those things. That's what I just wanted to put your guidance purpose, is not arguing purpose, is only for guidance purpose.
Sir, lot of times Income Tax Act does not have logic. Number one, but we can try to make a little bit logic out of Income Tax Act wherever it is possible, wherever it is beneficial to us, we'll go ahead and make a logic out of it. Now, when we say 2016 only it got transferred to me, the assessee is saying it got transferred to me only in 2016. Then the assessing officer would argue, sir, 2016 only it got transferred. How much did you pay for the transfer? 0, because it was a gift, it was a will, or it was an inheritance. Therefore, the cost of acquisition will become 0. That is a problem. To avoid that, we are saying that no. I have bought it, I have gifted it in 2016, but actually I bought it in 1981. When I say 1981, usually if it has been before assessment year 18-19, 1981 value itself you could have taken. 1981, whatever is the value you could have taken, indexation could have been done. But afterwards, after AY 18-19 onwards, 2001 has been, base year has been shifted. Therefore, 2001 only indexation benefits are available. Now that indexation benefits are available from 2001 onwards, you can go ahead and calculate the fair market value as on 2001, or you are allowed to take whatever is the cost as on 1981. Actually, it is a good thing you are trying to sell it now, because if you had taken the cost of acquisition from 1981, and if you are tried to do a indexation now, it wouldn't even have the 20 years that have passed between 1981 to 2001. That also you wouldn't have the benefit. It will be even paltry sum even then. But because it is 2001, when you calculate the fair market value, it will be a little higher. That's my understanding of this subject. Now, 2003 is where I have actually transferred this particular asset from land to a building, is what is the next contention that you are bringing. When you are transferring that particular asset from land to building in 2003, there is no financial transaction. You got, let us say, 4 flats are built. You gave half the land area as UDS to the other 2 flat holders, and then you have taken 2 flats in lieu of that particular land. It's more of a barter kind of transaction. For this, if there is an agreement in hand, there is a point of argument, you can say that this is the agreement that I have. 2003, I have transferred, I have retained the UDS, that is for sure. I have retained the UDS, that can be separately valued, but the building, I have sold this particular land worth so much. Probably in the document it would be there. The land is worth so much, it has been transferred, and building worth so much has been bought in my name. Therefore, the value of the building can be separately as ascertained, and it can be taken from 2003. Only thing is whether the assessing officer is going to agree to this or not. It's a different story, because there is a small transfer of asset, which we are saying it is transfer, but probably whether he is going to agree whether it is transfer or not is a question. So there stands the point. 2016 question is answered. Income Tax Act is like that. You cannot do anything. But 2003, you have a arguing point. Probably we can connect individually. We will figure out what can be done. Yes, sir.
Sir, my
Thank
question.
you, Santosh.
Sir,
Sure.
yeah.
Yeah, go
Sir,
ahead.
again, as a London building valuer. So what happens is that before 2016 or 17, before this demonetization, a lot of money was into black. It was not recorded, right, sir? Now what has happened now? A very peculiar case has come to me. In 1999, this person bought a property for which the ready reckoner or the stamp duty value was 2 lakhs, but he has paid only 50,000. So he had paid the stamp duty for 2 lakhs. There is no problem. but he has bought it for 50,000 only, that property. Now, my chartered accountant wants a valuation as on 2001. So what should I consider? Should I consider that 50,000, then say in 2 years it must have increased by say 10,000 only? Or should I say that no, the stamp duty value was at least 2 lakhs, 10,000. So I think the fair market value was say 2 lakh 10,000 or whatever.
Irrespective of the cost, sir, 2001 fair market only you should consider. If the stamp
Right.
duty value itself is say in 2001 from 2 lakhs, it has risen to 2,20,000, take 2,20,000.
Yeah.
I
Because
don't know
the-
where this
It is
kinds
up
of
to the
cases come,
SSC.
is it? Transfer happens at 50,000 rupees, but they have paid stamp duty for 2 lakh rupees. Sir.
Yes, yes.
As
Because the tax
as a
component used to
valuer,
be too high.
we have to value fair market value. Now
Right.
it is up to the SSC to choose, either he wants to choose the cost of acquisition or FMB for calculation of his capital gain. It is up to him.
Hmm.
Agreed.
And Vineet sir said that regarding the point that of improvement. Now, when we are valuing, as you also elaborated, when we are going back to that date of 1st April 2001, how do we say that yes, this was the value improvement? Let the SSC himself say, or it may go in the chartered accountant's report or the assessment, whatever he presents to the assessing officer. Why a valuer land and building should say ki, okay, in 2001 the value is there and he has done the improvement this way. That should
No. Correct. You are absolutely right. You don't have to say that. All that the valuer is expected, or as professional valuers, we are expected to give the fair market value as on 2001 only. That's all.
Absolutely. Yes.
From 2001 onwards, whatever is the cost of
That
cost
will
of
be
improvement
actuals.
that he has done, that is the even chartered accountant, he doesn't take responsibility.
Yes.
He will just give the value.
Yes.
The chartered accountant will file the return.
Yes.
When the assessing officer calls for the documents, he has to produce the documents.
Yes. And that will be as per actuals. Whatever you have as
Correct.
proof, you show it.
Agreed.
Right.
There is no requirement for the registered valuer to give a report that so much expenses has been made. If it is the valuation as on today, there is some logic for us to
Yes.
consider that. But if it is backdated, there is no requirement at all. You are absolutely right.
Okay.
Yes, sir. Go ahead, sir. Sanjay, sir, please go ahead.
Hello?
Yeah.
Am
go
I
ahead.
audible?
Yeah, sure.
Sir,
Please go ahead.
three, four doubts are there in my mind. As
Go
per
ahead.
the income tax provisions, if a transaction of transfer of any kind, give, sale, transfer, whatever, if it is taking place prior to 1/4/2017, then the cost inflation index to be referred to be 1/4/81, and after
Correct.
that it is to be referred as 1/4/2001. Am I right?
Correct,
In
sir.
that case, another point is that while doing the valuation of a real estate property as on 1/4/2001, should I take into consideration the depreciation of the building component or not? For the reason I am telling you, it's my doubt that prior to present scenario, the depreciation calculation was done on the basis of year, that is 0 to 5 years, 0 depreciation, 5 to 10 years, 10% depreciation, subsequent so on, and it was restricted to the extent of 60% maximum depreciation. Whereas nowadays, according to depreciation calculation, they are allowing after 5 years 1% or 1.5% per year, restricted to the extent of 70%. If a property is pretty old, because in Mumbai, there are many properties even more than 60, 80 years old property. And if I am doing the valuation as on 2001, then what should be the depreciation factor should I take into consideration? Or as per section 50 of Income Tax Act, whatever ready reckoner rate are going to prevail over, and in that situation, I should do the valuation according to ready reckoner rate. Please explain, sir.
Okay. So now when you are saying that it is restricted to 60% or 70%, one thing is very clear. The idea that when you are saying the asset has sustained from 1/4/2001 onwards till 2023 or 2020, 20 years it has survived. So the remaining value of 40% or 30% is readily justified there. So 1981, if you have bought the property, or if in 1971 you bought the property, for almost 30 years, 40 years, depreciation, whatever you have charged, even if you cap it at 70%, remaining 20 years it has survived. Therefore, the 30% is justified. You can go ahead as a professional valuer. I would suggest your own independent. Don't go to income tax and all. Income tax doesn't hold any power over a registered valuer, land and building. Your standards, what does it say? If the standards say 1.5% per year, you can calculate to a maximum of 70%. Start from 1971 or 1981, from whenever the particular building was built. From then onwards, you calculate the depreciation till 2001, and that value you can, whatever the remainder value that is there, you can take it as the fair market value of the building. Land is a separate issue because it's a non-depreciable asset. Land separately, you can UDS, you can separately value.
In that case, sir, will it be correct to say that I should do the valuation by land and building approach? In the sense, land appreciation, land component will be calculated separately and building component will be calculated separately. Am I right? One more thing, sir. In that connection only, when I go for the ready reckoner rate as prescribed by the government, and if I am in a position to take out the comparable instances during that particular period, which are much more as compared to ready reckoner rate, then whether income tax section 50 will prevail over the situation, or I will have to take the help of comparable sale instances which I have taken from the registrar office or IGR site, whatever.
Section 50 is applicable when it's comparing stamp duty value or comparing the guideline value will be applicable only on the assessee. It doesn't govern a professional like registered valuer. Section 50 is an anti-abuse provision, wherein the guideline value is so much, 1 crore. But somebody is trying to sell it for 50 lakhs and 50 lakhs he is trying to give cash. They want to stop that abuse of not paying taxes. Therefore, Section 50 is there. It cannot be extended to bring it back to 2001 and be made to be complied by a registered valuer. That cannot happen. So if you have comparable transactions and as a professional valuer, if you want to do a valuation based on comparative market comparative basis, you are 100% allowed to do it. You don't have to worry about Section 50 at all. Yeah. Next, sir. Next, anyone?
Sir.
Yeah, go ahead, sir.
Sir, I'm a land and building valuer. I'm asking you about the how we will measure the rural agricultural land from the boundaries. What are the boundaries of the municipal? Can you explain on that measurement details?
Measurement, one thing is very clear, sir. It should be measured aerially, not through land, rail, nothing. You should aerially, if you measure from the boundary. Boundaries are given by the department itself, not department, by the government. You will have the map. You will have a boundary from any boundary. From any place from the boundary, if you measure aerially to the place where your agricultural land is located, if it is within that 2 kilometers or 4 kilometers or 8 kilometer radius, then automatically you will come in. You will come into that particular regulation.
From where will get the
what
about the population? How where will get the population?
From the municipal corporation office or the local authority.
Correct. This is from the municipality. Municipality extent they will give. Absolutely right. I think Satish has said that. So it is from the municipality office only you will get this. There is a particular place in income tax website where the calculation can be done, but it will not give you the extent or all the different municipalities. They don't give that. If you are able to go to the municipality website, or if you go to directly to the municipality, find out what is the population. Now population, everyday population is changing. Where do I take the population from? That is also a big question. Population should be taken as per the previous census. So the municipality will have records for it. That data you can take from the municipality, and the extent also you take it from the municipality. We'll have to sit down and we'll have to measure. That's a problem.
Google Map, we can use Google Map now.
Yes,
Google
sir.
Map.
Yeah, Google Maps can be used. It can be used.
Thank you, sir.
Sir, what I would advise, suggest is you see if it is a municipal corporation or municipal council, first of all. So that will give you a fair idea that what would be the population of that place. Secondly, if it is then you can go, or nowadays it is available online. It will show you the limits of that boundary of that corporation or council. Beyond that, you can use the Google location and you can understand. You can get a fair idea. You can have an error of say 100, 200 meters. That will be there.
Correct. I agree with what Prashant sir is saying. See, today technology is there. You use the technology. Only thing is keep working papers. This probably most probably we as registered valuers, we usually don't do it. Probably if the client wants us to do it as a service, we can do it. Only thing is keep working papers so that you can produce the document to the department whenever it is required. Now coming back to Satish sir, again he has raised his hands. I had to come back to him. Sir, what you said is a different approach to it. As I told, you are using income tax approach. You are using income tax weapons against its own this thing. So I take this case. We brought it for 2 lakhs. This particular property is worth 2 crores today. 100 times growth, but inflation index was only 3 times. So if I take 2 crores and I reduce it back to 2001, it will only be 60 lakhs. Only thing is, as a definitely income tax valuer, income tax assessing officer is not going to accept it. For the main reason, he will use more scientific methods like comparatives. He will go on to take the records from the registration department, figure out there are other plots that are sold in that particular area at that point in time, and he will calculate what is the value of 1 ground of land in Chennai and that particular place that I am residing in. He will have a more authentic method, and once he has that method, he automatically will go back to the valuation officer. Essentially, we can go and argue with him, but the officer ideally will not accept this kind of arguments, where we use the cost inflation index to take it back. To an extent, if it is 5 years, if it is 3 years, 4 years, we can try to do it. If we are in 2004 or 2005, 3 years, 4 years, cost inflation index will be very less. The actual appreciation also, it will become very debatable. But now that we are 23 years later, it will be very tough from a practical standpoint to go and argue. If you have a better argument, probably I'm glad to listen.
And so their intention is to generate more tax for government.
Correct. That is the predominant intention. Yeah. So that will definitely not work out.
Yeah.
Satish sir?
For rural areas.
Yeah.
Hello?
Yeah, go ahead, sir. Go ahead.
When the data is not available, then only we have to resort to this kind of practices. Now, after all, the cost indexes of all the previous years, they are documented. I am taking
usually
property is
changing
what happens
hands. Is data non-availability will become a very tough thing, because if it is not available in your street, it will be available in the road. If it is not available in the road, it will be available in the area.
No,
if it is not even available in the area.
At times, it is easier said than done. When you start doing things, all the data is not accessible for you. Only thing is that all valuers, individual valuers or firms, they cannot have access to all the data, the sea of data that is available. I also know that. Only thing is to be able to come to a logical conclusion. I just wanted to know whether this methodology can stand the scrutiny at any point in time. Because like I say I belong to Delhi. The circle rates were announced only in 2007. Prior to that, there were no circle rates. Now somebody comes, okay, the property was purchased in the year 1991. You give me the 1/4/2001 की value so that I can use the indexation benefit and try to save on the capital gains. So what the most we can do is, even the guideline rates, they are very, very defective. In places, say in certain parts, they are more as compared to the market, or in other parts, they are very much less as compared to the market. Because the inflation is one guide, which is CBDT announces it every year. And if you take use of those figures to, see, the property has changed, say 2 crores of rupees in 2023. So if I calculate the value of the property in 2001, making use of the present value of rupees using the rate of interest average cost index rate for the last 20 years, I can arrive at a reasonable cost, because after all, the rupee has taken hit this way or that way, or maybe has inflation got a role to play into it. So if I arrive that and then take the indexation benefit, because some of my CA friends, they have accepted this methodology and they say it is fine. We have no action, because this way, this guy who is the client, he is going to benefit. Otherwise, the taxation part will be so huge that he cannot sustain.
Agree. Sir, this is,
So
I'm not saying this should not be done.
Whether it
This
is
is okay.
legally correct or not. This is what my question is all about.
Sir, can I
As
come
a
in, sir?
valuer, individually, this is more of an art than science. If this is given in the report, it's absolutely right. In the professional capacity of it, it is absolutely right. I'll quickly tell you a story. There were two guys. One guy who's a renowned forest expert. He walked into a forest. Along with him, one guy who doesn't know about anything about forest. He also walked inside. This forest, the guy who has knowledge about the forest, he said to the other guy, "Sir, there are lions in this particular forest, but I will tell you one trick. This lions, no, if you stand dead center of it, in front of it, it has vision this side and this side only. It will not have dead center. If you stand, it will not be able to see you." Just as you were saying, the lion came. This guy, no, he said, "Be quiet." The forest expert, he said, "Be quiet, don't run." The other guy, he did not listen. He started running. Automatically, the lion saw this guy also started running. Throughout the forest, they were running. The entire night, they were running. Morning, they saw each other. "Oh, you are alive. Very good. Now tell me, I told you very clearly, don't run when you see the lion. Stand right in front of it." We were right in front of it. I have told you, why did you run? The other guy who did not know anything about the forest, he said, "Sir, you know, you're a forest expert, you're a lion expert. You know that if you stand in front of the lion, it will not be able to see. Now that you have told me, I also know. Whether does a lion know about it or not?" Whether the lion doesn't know about this scientific logic or not. Same thing applies here. We are professionals. Both of us, we can use this methodology to calculate and we will prepare a report. But whether the assessing officer will he understand this logic or not?
That is the thing.
Because
Assessing officer is
May I come in?
Yes.
One thing, sir. There are two things. Satish
Okay,
sir said.
I just need to say was, okay, say he can accept or refuse to accept it. Fine. That is his viewpoint. I only want to say, am I doing any harakiri in doing this?
Sir, can I tell you? Can I come in, sir?
Please go ahead.
Sir, one thing is that as you said that there will be too much of tax. So the tax percentage is maximum 20%. He has just sold the property, so he will be having the money. He has only to shell out some amount as a tax. So we should not consider whether he can afford it or not, first of all.
You will be having black money also.
Yeah. So that is a different thing. Now, secondly, sir, supposing if you have bought some property in say 2001 or before that, and new development plan has come, which has changed it from agriculture zone to a very residential zone, and good development has occurred there. Now new cities may have come, so the land prices had increased tremendously. So the cost of acquisition, the income tax is concerned, आपने कितने का खरीदा, कितने का बेचा. Basically, they want to see कि cost of what was the cost of acquisition and what is the cost of the selling you are doing, right? So they will not accept that indexation of reverse indexation. This is what I feel.
Reverse indexation cannot be permitted, because anything which is done in a reverse way is not only you can go. But in the case of, like I said, I was referring to calculation of a asset in the context of calculating on the basis of present value of money, present value of rupee. I am just talking about the fiscal part of it. I'm not talking about anything else. Doing fiscal part, I also know all that, all these indexation benefits, black money, this money, all these things happen.
Yes.
See, at end of the day, as a valuer, as a professional valuer, what is your you have to consider your client also. You cannot ignore the client. His concerns also are of paramount importance. Because of course we should not do any harakiri as far as the laws of the land are concerned. You can bypass them, but you cannot ignore them. I am
Sir.
just wanting to learn whether by doing this, can we bypass that punitive measure if they, because after all, I am doing a legit thing. I am simply
assessing officer.
calculating the present value of rupee. See, in the year 2001, using all the available rates of inflation, which are, given to me by the CBDT. Am I doing anything wrong? This is what my question is all about.
As a
Sir,
valuer, you're right, sir. As a valuer, if you think this is the best method to go ahead and do the valuation, it is
Sir,
absolutely okay. Valuation report will be accepted by the assessee. Valuation report will be accepted by the chartered accountant. If you bring it to me as a fellow valuer, I will also accept. If you have a methodology, we will accept. One question that needs to, it is nothing wrong. It is legit. Everything is pakka as long as it is accepted by our folks, the peer group. But whether the purpose of creating that valuation report, whether it will be solved or not is the question, which is the test of the assessing officer. In my humble opinion, assessing officer might not be inclined to take this point. He will not say that, he will say that this is not a case. I don't think the fair market value is right. Refer it to a valuation officer. The moment it goes to the evaluation officer, the valuation that we have created, whatever formats, whatever effort that we have put, it all goes into the dustbin. He has his own way of doing the valuation, where he'll go on and find out circle by circle. He'll go outside and he'll find out what is the value in that particular circle and he'll apply. So that is going to happen. So this is my opinion on this matter. Anyone else, if you want to jump in?
and
please.
then he will justify that I am whatever I am doing is in the favor of government, that I am trying to raise the revenue. So that is also justified.
Come in here for a moment on Income Tax Act. If the transfer, somebody said now the transaction is done less than the circle rate.
मैंने बोला
If 56,210 will automatically apply, and it's a double-edged sword, even buyer, seller, both are going to shell out tax. One person is shelling out in capital gains, the other one is going to shell out in income from other sources. Probably you can throw a light on that for the audience. Sir.
No, that is
Yeah,
today's,
sure.
madam. That
It
is
is
for
there
today's.
in one of this, one of the next slides. It is there.
I am
I
talking
will
of
probably
1999.
Yeah, 1999 it was not there.
Yeah.
But today, if it is happening, what will be the effect? One of the slides in the following slides, I'll take you through probably 5 minutes, and then I will quickly run through that slides. Yeah, anyone else who wants to ask any questions?
Sir, yes, sir, I have a thing. It is more from a building valuation for the purpose of income tax. So very often we use CPWD rates. So can you give some light on how to exactly arrive at the building value using CPWD rate, because that is also got some base years and it keeps getting reset to zero every couple of years. So
I am not a land and building valuer. Probably somebody from the group, if you want to throw light into it, that would be helpful, because I cannot claim expertise. I know a little bit, but I don't want to claim expertise here. Any
I
expertise?
can you can refer to PAR rates. PAR rates which are circulated by GPWD in certain intervals, and you can apply the prevailing cost indices, which are also circulated by GPWD.
Sir,
They are the best.
I'll tell. Regarding 2001 building rate, you take 1992 CPWD rate and use cost index on 2001 and get the rate of 2001 and depreciate it when the building is constructed, so that you will get the exact fair market value of the building.
Here I would like to add a little point to all my friends in the fraternity, that what we exactly do, you simply take the PAR rates which are given for the only structure and finishing part of it. We almost always ignore the services part, which are an inherent part and should be included in those rates to get to the value, and depreciate it. Somebody had remarked that depreciation only up to a point of 70% can be affected. It may not be so, it can be more also, because depreciation, you simply calculate the reproduction cost on that day and come to that, see, this much has elapsed in the life of the building. After all, the functional life of a building is also assigned by CPWD.
That is
in
right.
the case of RCC with frames, it is more. It is in case of composite, it is less. So all those factors should be borne in mind. There are no hard and fast rules because whatever methods we use are, derived from the CPWD practice of things. And they are the best and they are the valid. Even in the income tax people, they cannot ignore them because after all, the Bible says so and we have to follow.
Yes, sir. Correct.
Agreed. Anyone else? Any questions?
Hello.
Yeah, go ahead, sir.
Hello.
Yeah, go ahead, sir.
Hello.
Yeah, we are able to hear you, sir. Please go ahead.
Sir, kindly, can we explain? Hello.
Yeah, go ahead, sir.
Sir, kindly, can you tell me the difference between market value and fair market value in case of capital gain tax?
Okay. Fair market value and market value. There is no
Both are-
definition for market
both are
market
same.
value. There is no definition for market value at all. The moment
both of
we
them
say
are not same. There is some difference. There is some
that
difference,
there
I
are
think.
different definitions that are there, sir. Fair
Some
market
difference-
value, fair value, market value, arm's length price, multiple definitions are there. The moment we say fair market value under Income Tax Act doesn't talk about market value at all. Talks about fair market value. Fair market value means there are certain items that needs to be considered. A couple of items needs to be considered. One, it needs to be an arm's length price. It should
Yes.
be between parties. Buyer and seller should not be related. It should be an
Yes,
arm's
yes.
length price.
Yes.
Second thing is there should be a reasonable amount of time given it. The particular asset should be in the market.
Yes.
So if you sell a pencil, I give you a pencil, I want you to sell it. You go out into the street in 5 minutes, 10 minutes, maximum 1 hour, you'll be able to sell that pencil. But if I give you my car, a sedan I give you, will you be able to sell it in 10 minutes, 1 hour? No, it will definitely take probably a couple of days. If I
Yes.
give my land, 1 ground of land, it will take probably a couple of years, probably a couple of months for you to
Yes.
sell it. Therefore, that much time we should assume has elapsed in the market of that asset coming into the market. So these are all factors that we need to embed for the market value to become a fair market value.
Fair market.
Ideally, when you say market value, I assume when you are saying market value, you are removing the fair part of it. Where if you sell it immediately, whatever is the value is the market value. Fair market value is you allow all these factors to be factored inside. Therefore, it will become a fair market value. But Income Tax Act doesn't talk about market value at all. It is only fair market.
Fair market value.
Sir, another question is there, sir.
Go ahead.
Okay. In case of sale evidence, if we find that market value as per circle rate is more than transaction price, what value we consider for sale reference in case of 2001?
Before 2001, you are saying the fair market selling price.
Market value as per sale evidence, circle rate is more than transaction price.
More than the transaction price. Usually, it will not be the case, sir.
When we consider the sale evidence, what value we consider as a sale evidence? What value? Market circle
2001.
rate or 2001?
2001, you consider only the circle rate because circle rate is higher, beneficial for the client also. As a valuer, you are supposed to take up what is the fair market value, irrespective of whatever is the cost price. You go ahead and take the circle rate. That is 100% acceptable. This is my understanding. You are saying you bought it before 2001 and you bought it at 50,000 rupees while the circle.
For the purpose of sale evidence, sir.
For the purpose of?
Sale evidence.
Sale evidence. What is sale?
For calculating the fair market value as on 1/4/2001.
Okay, for that you can take the circle rate. Sir. Circle rate is, should be enough evidence for you to represent before the assessing officer.
If circle rate is available, it is the correct. Yeah.
Correct. Circle rate is available now. That should be more than enough for you to go ahead and substantiate it in front of the assessing officer. In fact, there is one question that kept going the rounds where, sir, can I take only the circle rate? Can I also take the stamp duty value? That day, if there is 11% stamp duty value, that particular property was in the circle, the rate is 1 lakh rupees. Can I take 11% extra because stamp duty anyway we should have paid to purchase that particular property? So can I take 1,11,000 is one interesting question that I have received during one of my sessions. It was going the rounds, but I, in my honest opinion, would ask you to stick to only circle rates because when you say acquisition cost, The circle rate can be very clearly established, but the moment you add that 9% or 7% or 11%, automatically it will become a disputable idea in the assessing officer's mind. He will take that, use that as an opportunity to take it for scrutiny and send it to the valuation officer. So stick with the circle rates to the extent possible.
Sir, I have one question.
Go
If,
ahead.
valuation certificate is not required, in the sense, there is a transfer between two individuals, the Income Tax Act says you have to determine by the rules given there. When we determine it, in case of land and building, if I have the registrar's certificate saying that this is the value, would that be a good evidence for me as a SFA or a chartered accountant to determine the value, or should I go for a valuation certificate from a land and building, plant and machinery valuer at this point in time?
Correct. For the 2001 valuation, there is no requirement from a registered valuer at all. That is very clear. The Act does not prescribe a report at all. If you have other evidence, if the registrar's report is there, and if you think that it is convincing enough for the assessing officer, that should be more than enough. I am talking about registered valuers, not as a reporting or a government authorized service kind of thing. I'm not talking about that. I'm talking about more of a general where chartered accountants for small taxpayers, it's not required. We just prepare the returns, we file for them.
Data is not available. Yeah.
If
Where there
data
is
is not
data is
available,
not available. Registered valuer
correct.
come into play where there is these data are not available.
Right,
Yeah.
sir.
Yeah. Straight away information is not available, a better person can look at it. I usually go and take a paracetamol if there is a small cold. I don't go to the doctor. But if there is a more serious problem, I go to the doctor. Same thing.
Yeah.
No, but madam, you please take the valuation report from land and building valuer. Otherwise, that business will
No,
go
no,
down.
not in that sense, sir.
Good. So let me quickly, I have another 20 more minutes. Let me quickly run you through the other sources of income. I'm going to run through, I'm telling you here. So just stay with me here. Subsection 2, clause 5 was the first time when income tax realized that people started moving money from one person to another. They found out that they're moving money, they are doing some transaction, but the transaction is going through the bank, but they are not saying that the transaction is the actual transaction, they're saying it's a gift. Therefore, they found out if any person is receiving more than 25,000 rupees, they started to tax it. Only for individual and HUF it was applicable. Then 56 subsection 2, clause 6 replaced clause 5. They said if it is more than 50,000, it is taxable. Then they figured out somewhere around 2017 that not only money, other kinds of transactions are also happening, where land is being given at half the price. All these transactions are happening. Therefore, 56 subsection 2, clause 7 was introduced to take over clause 5 and clause 6, where not only money, but other assets, 3 or 5 other categories of, I think 3, it's wrongly typed, 3 different categories are being brought in. From 2009 to 2017, it survived. And then they also figured out that people were incorporating companies and they were trading in unlisted shares. To stop that, 56 subsection 2, clause 7A was introduced. Now, from 2017 onwards, all this is consolidated into 56 subsection 2, clause 10, where all these 3 categories are brought into play. And who is the recipient? It used to be individual or HUF. Then in 2010, they brought in that firm or closely held company. Now, any person, it can be any person, if they are dealing in this transaction, if they fall under this section, it will become taxable. What is taxable, sir? 3 different categories. Sum of money exceeding 50,000 rupees if you are getting as a gift. Obviously, exemptions are there. You are getting it from your father relatives, not taxable. Getting on the occasion of marriage, not taxable. You would have written your, when you wrote your return, registered valuer examination, you would have had this income tax. Major question, if somebody gets a gift of 50,000 rupees or 60,000 rupees on the occasion of his marriage anniversary, whether it is taxable or not, very popular question. I'm just trying to kindle your memory. Anniversary night is taxable. On the occasion of marriage only, it is exempt. All these questions used to be there. So any sum of money. Immovable property peculiarity is there. Without consideration, if you are getting a property, then the stamp duty value, if it is exceeding 50,000 rupees, then it is becoming taxable. If it is less than 50,000 rupees, they are leaving it. Without adequate consideration, where the difference between stamp duty value and the actual value exceeds 50,000 or 10% of the consideration, whichever is higher, then it becomes taxable. Any other property, instead of stamp duty value, replace fair market value. This fair market value again is determined by us only as registered value as we can determine. We can keep it for our purpose. Now, I'm going to skip. Oh, this is something that I wanted to skip this, but since somebody asked, I'm going to bring that in. Whether consideration received or where consideration is received or accruing as a result of a transfer by an assessee of a capital asset, being a shares of a company other than quoted share, is less than the fair market value of such share, determined in such manner as may be prescribed. The value so determined shall, for the purpose of section 48, be deemed to be the full value of consideration received or accruing as a result of such transfer. For this purpose, fair market value we'll have to go to the rules. Now, what happens is when you are actually transferring, I'll take you to the table for better clarity and understanding. When you are transferring an asset, this is only transfer of shares. It is also applicable for other assets. If you are transferring it if you are transferring it above the market value, then for the buyer, no problem. He is buying it at higher value. He can take it as cost of acquisition. For him, no problem. For the seller also no problem, because he is trying to sell it at more than market value. He is paying his taxes properly. For him also no problem. Above fair market value, no problem. Today, FMV as on today. But if you are trying to buy or sell below the fair market value, both buyer as well as seller will be caught in trouble. Why? The buyer, he has to go through 56 subsection 2 clause 10. The property is worth 1 crore rupees. He bought it for 70,000 rupees. Now this 30 lakhs, the difference will be taxed under other sources income 56 subsection 2 clause 10. Seller, sir, he is paying taxes, no sir, for the 30 lakhs. Whether I am left alone, no. I will also be taxed under 50 CA, where the difference between the consideration and fair market value will be taxed under capital gains itself, not other sources income. Buyer will pay the tax under other sources income. Seller will pay the taxes under capital gains. So the entire property is worth 1 lakh rupees. For 70 lakhs rupees, seller has already paid a tax. For the 30 lakhs, he will again pay tax. So entire 1 lakh, he will pay taxes. Buyer also will pay taxes for 30 lakhs. So for a property worth 1 crore rupees, FMV worth 1 crore rupees, 1 crore 30 lakh rupees will be the taxable value, and you'll have to pay taxes for that. Both seller and buyer put together. Ideally, for this purpose, make sure that stamp duty value is properly ascertained by a registered valuer in any transaction involving land or building or any asset. In case of other than land or building, fair market value is being determined by a registered value. Usually cash, you don't need any valuation. Immovable properties, it's not ideally given out. It is being valued by the valuation officer, departmental valuation officer. AO will refer it. He will do the valuation. For any other property, it can be valued by 3 people: chartered accountants, registered valuers, and merchant bankers. Usually for jewelry and archaeological collection, artistic works and all, what you can do is, ideally, the value, if you are buying it from a registered person. Who is a registered person? If you are registered under GST Act, CST Act, VAT Act, if you are registered, you are a registered person. If you have a bill which states that this is the value of the property, value of the asset, and this is the rate of tax that is applicable, automatically that will be accepted as a fair market value. In case if it is not there, then you'll have to go back to and find out a registered valuer empaneled with Income Tax Act. With regard to securities, for SFA valuers here, 3 kinds of securities exist in this universe: quoted shares and securities, unquoted equity separately, and unquoted shares and securities other than equity shares separately. Quoted equity shares, pretty straightforward. You go to the stock exchange, you find out what is the average rate that is prevailing. You take that. If it is not trading on the date of valuation, you go to a prior date and you calculate. Pretty straightforward. And the paucity of time, I'm going to skip that. In the case of unquoted equity shares, they give a very beautiful methodology. Whether you ask me whether it is scientific or not, I don't want to comment on it. It's not scientific much to my opinion, but okay, I'll reserve my thought there. But this is the methodology that is prescribed. Does it require a report from a chartered accountant? No. Doesn't require a report from a chartered accountant. The client or assessee himself, he can prepare it. But usually what the client does it, he gets this his financial statements to the chartered accountant. Today, as a registered valuer also, we can do it. If you're not a chartered accountant, if you're a cost accountant, you're a company secretary or a registered valuer, you can go ahead. SFA valuer, you can go ahead and do it. read the financial statements, apply the formula. I don't want to get into the formula because it is very confusing. But it's not very tough, but it's a little confusing. You'll have to take all the book value of the assets, remove the items which are specially dealt in sub-rule, not sub-rule, sub-clause to the sub-rule. A and B, whatever was already covered, you'll have to take it out. Then you will have to add certain items, reduce certain items, and you arrive at a value. That will be the A plus B plus C plus D minus L is your liabilities. You remove it, you arrive at a value which will be the enterprise level value of that particular company. Then you go on to multiply it with the PV, which is the paid up value of the shares of the company, divided by the total number of paid up equity shares that the company has. Divide into PV divided by PE, we do it for calculating the per share value. So this I'm going to skip here quickly. Now, with that, we move on to 56 subsection 2 clause 7b, which is angel tax. What is angel tax? Sir, so far we have been discussing only about transfer of shares. Can issue of shares also come into play here? Yes. If a company is issuing shares, there's an amendment here. That's why I'm bringing this here. If there is an issue of shares, there also, if you are issuing it at a price lesser than the FMB, it will become taxable. So who will become taxable? Who can issue shares? Only a company can issue shares. So far, it can be 56 subsection 2 clause 10 is applicable to any person. 56 subsection 2 clause 7b is applicable only to companies. What kind of companies? Only companies where public is not substantially interested. So listed companies, they don't come under 56 subsection 2 clause 7b. Unlisted companies only will come here. What kind of transaction is taxable? Transactions where receipts are made in the previous year for issuing shares. There are two exceptions. If the receipts of money is from a venture, is by a venture capital undertaking. What is a venture capital undertaking? Unlisted companies where they have taken venture capital fund, it becomes a venture capital undertaking. If they take funds from venture capital company or venture capital fund or a specified fund, that kind of transaction, they give an exemption. By a company from a class or classes of person as may be notified by the central government. Central government has notified certain companies, certain investments, that is again exempted. Now, angel tax, there is one another notification that came in where if you are registered, the venture capital undertaking or the unlisted company, if they go on to take that startup registration, and if they are designated as a startup, then automatically this section 56 subsection 2 clause 7b does not apply. I'm going to skip it here. Okay,
Can you have
quick,
one question here, sir?
Yeah, go ahead.
In case of rights issue, and if it is renounced to a third party, it is a matter of concern, and should we have the valuation done and to be issued at the FMB?
Rights issue, madam, if it is, see, rights issue for the company's purpose, it's not required. As per Companies Act, it's not required. But if you are the holder of the shares and rights issue has been made, you are renouncing it for a value to another person. Individually, do you have to do a valuation? Yes, you'll have to do a valuation.
Thank you, sir.
For the purpose of Income Tax Act.
Yeah.
In respect of the startup exemption that I told you, in case later they find out that startup, the conditions that are required for you to remain as a startup, you did not satisfy it, you will be taken back to that particular year and it will be charged in your hands on that particular date with 200% penalty. Therefore, that is something that you'll have to keep in mind. Now, above fair market value, if the shares are issued, or if it is a startup, exempt, no taxes payable. If it is a non-startup, then the difference between the issue price and the fair market value will be taxed in the hands of the company. The shares are worth 100 rupees as per FMB, but if they are issuing it at 120 rupees, 20 rupees will be taxed in the hands of the company. If it is below fair market value, if it is a startup, it is exempt again. For a non-startup, no tax impact because the company shares is worth 100 rupees. They are issuing it at 80 rupees. There is no impact. Usually, I don't know, there is something missing here, but still, let me continue. Usually, up to somewhere around 2022, this will not apply to non-residents. If the allottee is a non-resident, then there is no problem. You will not be covered under 56 subsection 2 clause 7b. Now, with the recent amendment, They opened the Pandora's box where they are saying, even if it is a non-resident, if the allotment is made at a higher value, 56 subsection 2 clause 7b will become applicable. That is what is missing here. Issue of shares to non-resident is not covered under 56 subsection 2 clause 7b. Older scenario. Now non-residents also are also brought into the ambit. Probably I have not opened the latest edition. Probably a older edition is in my hand. So that you'll have to keep in mind. This is the reason why there is another amendment that came on 25th of September 2023. I'll come there. If shares are issued at face value under section 56 subsection 2 clause 7b, irrespective whatever is the fair market value, my shares fair value is 10 rupees. If even the fair market value is 2 rupees or 3 rupees, if I allot the shares at 10 rupees, 56 subsection 2 clause 7b does not apply. This is something that again you'll have to keep in mind. Now, I have in the previous case 56 subsection 2 clause 10, sir, you talked about buyer as well as seller, sir. In 56 subsection 2 clause 7b, you spoke only about the allotter, the person who is issuing the shares. What happens to the issuee or the allottee? That is one question that should have come to your mind. In case of the allottee or the issuee, the taxation is not a very clean area, it's a murky area. To resolve this, fortunately or unfortunately, I don't know where the idea came to CBDT. In 2018, they woke up and they came in the defense of the assessee. You will not believe it, but in the defense of the assessee, they came out with a notification or circular 10/2018. But immediately in 2019, in October 2018, they issued this circular. And immediately in February 2019, they went on and they quashed the circular, stating that a lot of cases are pending in the court. We don't want to issue any circular. Therefore, we are quashing the circular. Essentially, the CBDT circular said that it is a legal gray area. 56 subsection 2 clause 10 was supposed to be an anti-abuse provision. So therefore, we don't want this to impact the allottee. But because it is a matter of court, it is a matter of it is in the jurisdiction of the court. We don't want to interfere there. So therefore, we are withdrawing the circular. They have withdrawn the circular. So that's where it stands. We don't know what happens to the allottee in case if it is issued at a price higher or lower. There are a lot of case laws that are there. You can go through and send the file. You can take a look at it. One of the cases is the rights issue. So you can take a look at that also. For the purpose of this clause, fair market value of the shares will be the value as may be prescribed in two ways are given. One is to as per the 11UA subrule 2 method. The other is the easy method. As may be substantiated by the company to the satisfaction of the assessing officer based on the value on the date of issue of shares of its assets, including intangible assets, blah, 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 blah. So essentially what is important is satisfaction of the assessing officer. They have a way in which if the method, which is a very brutally wrong method or brutally unscientific method, if that you don't want to take that very bad or murky road, go ahead and you satisfy the assessing officer with all the documents that he is asking for. I will leave it at that. Go ahead and use your imagination there. Next, whichever is higher, so you will be saved there. Valuation of unquoted equity shares, 11UA subrule 2 clause A is something that I want to bring to your notice. Same thing, sir. Whatever is there in subrule 1, same thing will be here. Only thing is small, very small corrections are being made. Instead of A plus B plus C plus D minus L, they are saying A minus L. In the operation of A, B, C, D, is not, if you put all that together, it will not be the A here. Small changes are there. I'm going to share it again with you. You can take a look at it. I just want to discuss a couple of things. I think I'm running out of time, 2-3 more minutes. One more method in the 11UA subrule 2 clause B, they are mentioning about valuation of unquoted equity shares. In that case, they are allowing merchant bankers, used to be chartered accountants also. Now chartered accountants are removed. Merchant bankers can go on and do a valuation in the discounted cash flow approach. Discounted cash flow method, sorry. Approach is the income approach. The methodology is discounted cash flow method. They are allowed us, they've allowed the merchant bankers to do that. Now, I'm going to skip all these definitions. One thing is very clear. for all these calculations, you need the balance sheet. What balance sheet to take is a very, it's a very tough question to answer, because in certain cases they are saying balance sheet of the previous signed audited balance sheet you can take. In certain cases they are saying on the valuation date, go ahead and get a audit from the chartered accountant, which is very tough, not possible. So usually we take the provisional financial statements. Unquoted equity shares, all this I'm going to skip. This is the point that I want to drive. While I'm valuing the shares of company A's shares hold shares in company B, and company B holds shares in company C, and company C holds shares in an immovable property. For me to value company A, you'll have to start with the immovable property that company C holds, then value company C, then value company B, and bring that company B's value to company A. All this valuation should be done in the methodology as prescribed by the rule. Very tough. Number two, what happens if company C is holding some shares of company A, then there is a cross holding. The moment there is any cross holding in an enterprise, the entire methodology of 11UA fails. Both in this case, sub-rule 1, sub-rule 2. It will fail because cross holding does not go well with the methodology that is, the calculation methodology that is given. Audited balance sheet on valuation date for every transfer of or issue is a very tall ask. The bigger problem arises when this is requested from the subsidiaries also. If it is a wholly owned subsidiary, at least I will be able to squeeze them and get it. If it is some investment that I made, I hold only 2%, 5%, what will I do? And the biggest problem is when a shareholder is supposed to procure the same. Very tough. Investment in foreign subsidiaries, again, that is a very big problem, because if in the case of stamp duty value, when I told immovable property, I talked about stamp duty value. In India, stamp duty value will be there. Where will you go for stamp duty value in the foreign country? Well, they are not talking about anything else or a equivalent in the foreign country and all. The methodology does not prescribe, therefore it will fail. With this, I'll take you to, let me quickly open up the 2023 September 25th wala circular. What happened is, so far I have described only two methods for you. One method is the 11UA sub-rule 2. The other method was the merchant banker method. Now there is a third, fourth, and fifth method that is being introduced by the department. Why? Because non-residents are also asked to come under clause 7B. Now when foreigners come, they look at the methodology and they start laughing. So they introduce the third, fourth, and fifth method. First method is the same. Second method, fair market value at discounted cash flow basis. That is also the same. Third method is where any consideration is received by a venture capital undertaking. If you are a venture capital undertaking, you receive from a venture capital fund or a specified fund, within 90 days, before or after, if you take funds from any other person, then automatically the value that you have determined for the transaction with the venture capital fund, that will be considered as the fair market value. Understood? I am a company, I am a startup, I took funds from a venture capital undertaking. Sorry, venture capital fund. I am a venture capital undertaking, I take it from a venture capital fund. Tiger has come in and invested in me. And another 1 month, one of the individuals who wanted to invest in my company, he brought in, let us say 20 crores, 30 crores. He invests in my company. If I provide the same value that I provided Tiger, if I am valuing my company at the same value I valued for Tiger, for this person also, then automatically that will be a fair market value. If I am pricing it a lot higher, I priced it at 100 rupees for Tiger, and I am pricing it for 150 rupees for this individual Ram, then automatically that 50 rupees will become tax. So fair market value for 90 days before and after will be the transaction value of the venture capital undertaking and venture capital fund, whatever was the value. Now, apart from this, there is a fourth method. In the fourth method itself, they are asking the merchant banker to do valuation under 5 different methods. One, comparable company multiple method, probability weighted expected return method, option pricing method, milestone analysis method, replacement cost method. only fair market value, sorry, discounted cash flow method was allowed earlier. That is there, still there in one of the subclasses, subclass B, subclass D, they are opening up for 5. Then there is a fifth method where the consideration is received from the company for issue of unquoted equity shares from any entity notified as per clause 2 of first proviso to clause 7B. That transaction also same thing as venture capital fund undertaking and venture capital fund. If you have received funds from notified entities 90 days and before and 90 days after, you can take that as the fair market value. Again, there are a lot of ideas as to what clause applies to who. For non-residents, clause A to clause E will apply. Clause B, clause C, clause E will apply. For residents, only clause A, clause B, clause C, and clause E applies. I don't want to confuse you here. I'm going to share this PDF. Please go through these 5 methods. Used to be 2 methods applicable for everybody. Now there is 5 methods, of which certain methods are applicable to non-residents, certain methods are applicable to residents. Please take a look at it. Anything that I'm missing out? I think pretty much we have covered the basics of it. This is other sources area. I will share it with you. Please take a look at it. If you have any doubt, I am ready to answer. If you have any questions now also, I'm ready to answer. Please go ahead.
So this new 5 methods of valuation is prospectively or retrospectively? It can be applied also?
No. It is applicable from now only. No, it's not retrospective. Any other questions? Okay. Thank you so much for staying with me for the entire 2-hour session, probably a little more also. Quickly, let me share the. Okay, so I hope the slide is visible. If you want to reach out to me, please, this is my mobile number. I'll close the session with my usual quote. Try not to become a man of success, but rather try to become a man of value. As a valuer, I think Einstein has given us a very good sentence for us to go ahead and tell the entire world. So thank you so much for staying with me. Somebody from DJF, please take over. Kajal, you're there?
Did you guys?
I think they're not available. I think we can exit the session. Thank you. Have a good day. Bye.
Thank you so much, sir.
Thank you.
Thank you, sir. Thank you very much.
Santosh, thank you.
Yeah. Have a good day.
Thank you, sir.
Thank you, sir.
Thank you, sir, for the lovely session. I actually
Thank you, sir.
give the ending session, but I think there's some.
Thank you, sir.
Is not able to
Thank you.
join.
Thank you. Very useful and informative, sir.
Thank you, sir.
Of course,